Hello and welcome to the No Flipping Excuses Show, the only podcast in real estate investing that teaches what you need to know to find and flip deals right now. Wow. Break free the chains that are holding you back and join us on this episode with Jason Lucchesi.
Hey, what's up, everyone? It's Jason Lucchesi, and welcome to the No Flipping Excuses Show. I am super excited that you are here with us right here, right now, because we're going to be discussing some amazing things that are going on with our special guest. He's doing some multifamily, some syndication deals, and he is just doing stuff that I absolutely love. And I am so happy that we were able to get him on here and have him share what he's doing in his investing business. So without further ado, I've got Adam Adams with us. How are you doing, Adam?
Excellent. How are you?
I'm doing good, man. Thanks for joining us on the show today.
Thanks for having me.
Absolutely, man. I know you're doing some really incredible things, and I'm excited to have you on here, man. But for folks that don't know you, if you don't mind, can you share a little bit about yourself and, how did you get into investing and what you're doing today?
Yeah, absolutely. So I guess the short story is that my dad's always been investing. So I kind of grew up thinking that when I get old and boring, that's what I'm going to do too. But he did something interesting. Well, I was in college. This was back in 2005. He bought himself a piece of land and then he gifted it to me for Christmas.
Nice.
All right. So I was like, oh, cool. Thanks, Dad. I mean, I don't know what to do with it, but I appreciate it. And he goes, yeah, I bought this for $100. I thought that you would want it. And I was like, oh, great. Thanks for this present. And a couple days later, he goes, oh, hey, I'm going to have you buy that from me. And I was like, what? How much? And he goes, I need you to give me like $100. I said, you paid $100. I thought this was supposed to be a Christmas gift. All right. So out of nowhere, I say, I don't know where I'm going to come up with this. I'm in college. I'm, working full time, or I'm working as a server, and then I'm going to school full time. Like, where am I going to come up with $100? It sounded like so much, but I was like, whatever. My dad's going to make me do it, and I'll probably never hear the end of it. So I gave him the $100. He transferred the title to me, and then all of a sudden I had a tax bill. I was like,
no.
What? So the taxes were like another $100 a year. And so I paid this tax bill. The next year came and I paid the tax bill. So this was every spring. So I paid the first tax bill a couple months after. And I was like, that stabbed me. This is a liability. Robert Kiyosaki.
Yeah.
This is a liability. It's taking money out of my pocket. It's not paying me. And I paid that one more time and it hurt. But then somebody said that they'd buy it for $12K. I said, dude, take it. But the lights kind of went off, I was like, you know what? Real estate's kind of powerful. So I'm going to figure this out. So Robert Kiyosaki, we mentioned him. He got his wealth in multifamily. So he did multifamily. So I said, that's what I'm going to do. I'm going to go into multifamily. I had just sold this piece of land, made a couple dollars. I said, I'm going to go and buy multifamily. So I started by managing properties. I called every single property that had every single building that had a vacancy. And I said, hey, I want to come and rent from you, but also I want to be your property manager. I have no experience, by the way. It took about 20 people. And then finally somebody took a chance on me.
Nice.
And that's how I really got into managing multifamily and learning what it was like to reposition a property. Because he said, I'm not going to own this for too long, but I'll let you manage it while I have it. You've got to raise rents. You've got to cut expenses, and I'll teach you how to do it. So this guy's name is Reed Quinn, and this was in Utah. And I found out that I repositioned a property, made this guy $1 million. Wow. Well, at least I thought I made it for him. But I did all of the work, and I learned the ins and outs of what it means to reposition a property, turn something from 1 million to 2 million in a year. And again, light bulbs went off. This is such a powerful industry. So I bought my first multifamily in 2008, and you can guess what happened.
Yeah.
I struggled a little bit, but I made it out unscathed, and now I own 600 or so doors, and
nice.
Really enjoying doing the syndications.
Nice, dude. That's awesome. So for folks that don't understand what reposition means, is it almost kind of like a value add as well? Are those two things kind of synergistically one and the same, or?
Yeah, that they are fairly synergistic. They mean pretty much the same thing. A reposition you could do on practically anything. A hotel that's run down, value add, or a business. You could reposition a business that maybe somebody could have taken Toys R Us before they went under and put them online. Say, hey, I know this is coming down, but let's add some value. Let's go online. Let's compete with Amazon or whatever in the toy business. And if somebody had the knowledge, the experience, the brains to go in and change that or reposition it, yeah, that's exactly what it is.
No, that's awesome, man. So you realized that you wanted to get into multifamily. I know you and I kind of talked a little bit when I reached out to you on Facebook. Hey man, I see that you're doing some really cool stuff and I wanted to get you on the show. And you weren't quite sure what the show was about. And you're like, well, I'm not sure if I would be a good guest. I'm like, I don't know. You're doing some pretty good stuff. And you're talking about your residential side. I'm like, no, it doesn't have to just be about residential. And you're like, okay, good. Well, then I'm your guy. So I wanted to talk with you about the apartment stuff. So for people that are just kind of getting their feet wet with real estate, why would you say the commercial side is the more advantageous route to go than single family? Not saying like there's nothing wrong with single family, especially if people are getting into wholesale. You could still do wholesaling with multifamily and all that stuff too. So not saying anything's wrong with residential, because that's what we do most of our stuff with. But I wanted to talk to Adam, who's obviously an expert on this stuff, about that.
Okay, so I think that there's multiple ways to go, and Stephen Covey mentioned something beginning with the end in mind. He had those 7 habits, and one of them was begin with the end in mind. So if you want to have a wholesaling business and you want to retire and let that wholesaling business run itself, then you should begin with that end in mind, knowing that you'll do wholesaling, but you'll let it retire you. If you want to do fix and flipping and you don't want to have, hire yourself for a job, you need to begin with the end in mind. And what you want is just thousands of units paying you passively and having management, then in my opinion, there's no reason to start with wholesale on single family or fix and flip on single family. You should begin with the end in mind. If you know what you want is multifamily, start there. And you say, I don't have money. Well, okay, we'll raise equity. I'm raising equity in my first 122 rentals. I didn't put a dime in, right? So it's okay. You can solve that problem instead of telling yourself the excuse of, well, I can't start that now. I have to do maybe wholesaling first. In my opinion, if you want a multifamily, then wholesaling single families is, to me, just a distraction. But if you want to wholesale, do wholesales now. Just start in the place where you want to go, because that focus is going to propel you. The focus on just saying, you know what, I'm going to be wholesaling. I'm going to be the best wholesaler. I'm going to start a company and I'm going to let it retire me, or I'm going to sell the company, live on a beach, whatever, do it.
Yeah.
For me, it's easy enough to partner with other people to say, I can be more of the connector. So this is just Adam's role. It is kind of like this connector role. So it's like you go to somebody who has a ton of money and they don't know where to put it.
Right.
And you say, hey, if I built a team around me where we found opportunities for you to place your money for 2 to 5 to 10 years, and you got returns of 15, 16, 17, 20% annualized, would that make sense for you? So he or she probably says yes.
Right.
And then you go to somebody who is ridiculous at wholesaling, who's been able to find deals, who has put their systems in place, and they know how to find those great deals. And then I might go to them and say, hey, Jason, you're super good at finding deals. What if you found bigger deals instead of littler deals? And then I brought all the funding, I brought all of the management to you. Oh, yeah. hey, and then I go to the next person who has experience with these, but they don't know how to find the deal like you do. And I'll say to them, look, I know it's hard to find a deal, but I got a guy. He's really, really good at finding deals. He's been doing it, with single family, and he's starting to do it with multifamily. If we find these and this other guy funds it, will you just manage it? Yes. So you kind of create win-wins out of thin air so that you can build a team around you. And that may sound hard or difficult, but for me, this year I'll probably close on over 1,000 doors in a year. And for the most part, I've put very, very little money in out of my pocket. And, we are building and generating passive income. So that's my approach. That's what I want in the end. So I cut out every other distraction to get there.
No, I like that you bring up distraction because, a lot of us, we tend to lose focus. And when you lose that focus, you never really have a straight path. That's why, if you've ever seen one of those pictures where it's an entrepreneur and they're going up and down, up and down, up and down, it's because it's in my opinion, lack of focus. And I really like what you said there with distractions. Because a lot of folks can get caught up in distractions. So with you now going down the multifamily route, or maybe even some other commercial projects as well, some people may be like, well, I can't find deals. I would say, well, don't have LoopNet be your only source. What would you say you don't have to share everything, but what would you say is like maybe one or two good sources for you on sourcing actual commercial assets?
The best answer, if somebody says I can't find deals, you need to ask yourself, how can I find deals?
Sure.
How can deals be found? So honestly, if somebody was having a hard time, I think they should partner with somebody else who's having an easy time.
Okay.
That's the best answer. But for us, what we do is we focus on social media to allow people to see into the business, and we add value. So we get an insane amount of deals coming by. They don't all work. In the last 6 months, actually our underwriter, the acquisition specialist, just added up every deal that he's looked at that has come where he's actually analyzed the deal. So we passed on 261 opportunities in 6 months.
Nice.
The average is something like, 20 a month, and we'll buy a total of 4 in 6 months, which is like 700 doors.
Sure.
So our approach was different. So to tell somebody, how do you do direct marketing? I'm not your expert. To tell somebody how to make your cold calls to the brokers, I can tell you really well how to do that, but I can also say that it takes so much time and effort and CRMs to call all the brokers to always be front of mind. It was easier for me to create a thought leadership platform so that deals just come to us. Gotcha.
So when you're getting involved with multifamily projects, obviously it may have been a little bit different going from residential to commercial right off the bat. Would you say there's a difference in evaluating a residential deal versus a commercial deal?
Yeah, I'd say there's quite a bit of differences. In general, you're on a residential, you want to look at the foundation, mold, termites, all of those things that are hazardous.
Sure.
Even the soil conditions, if there was ever oil that got dumped there. These are things that are important to evaluate and understand. But the biggest real difference, there's two. One is you have a whole team to do the due diligence with you. And the second one is in multifamily, in general, you're buying a business. So instead of purchasing just the property, you're purchasing the income that property generates.
Gotcha.
And so you'll look at it that way. You'll look at it in more of if this is a risky area, I want a higher return on my money. If this is a low risk area, I'm willing to have a lower if I have these kind of tenants, I want a higher return. If I have these kind of tenants, I'm okay to take a lower return. So you really care about the business, what the business is doing, and it's based on really NOI, net operating income,
Yep.
and a cap rate that's in that area.
No, I would agree with you wholeheartedly on the commercial evaluations there, because it's going to vary. Wouldn't you say in market to market what type of cap rates you're going to be receiving? Like in New York is going to be, single digits, and Midwest right here, you're going to see double digits. I don't want to say easily, but you're going to see them much more common than you are, in like a New York market or even in a California market. So when you're evaluating, you're paying for that business. You're paying for the income that's going to be coming in on a monthly basis. So the evaluation, when I've looked at some commercial properties before, I typically want to get 2 years of previous financials from that individual so I could look at the expenses. And at that point, there's some opportunities that could potentially come up on there too, right? Because you could kind of see like, here's some of the repositioning that I could do in order to increase value in that property. Would you agree with that on there, Adam?
Yep, 100%. You're right.
Okay, cool, man. So when you're purchasing a property, commercial property, what are some of the things that you tend to look for from a due diligence standpoint? Because obviously sometimes it could take a little bit longer than a residential deal. And appraisals are much more as far as how much they're going to cost and the length of time to get one of those done. So what would you say as far as due diligence? What do you typically do when you're going into a deal?
Some of the important things that can bite people in the butt is having a rent roll. So you always want to look at the rent roll, but when you're doing due diligence, like you said, you want to compare the rent roll that you have with who's actually paying, and you want to check to see if they're real people, and you want to check to when the leases expire. It's crazy how many different variables there are to every detail. We could go in the weeds just of rent rolls. We could have an hour-long conversation of the real due diligence that you need to do.
Right.
That's the truth about it. But you want to verify maybe these people don't even live there. Maybe they're fake names and fake amounts. Maybe the person says that they're paying $500, but they're really paying $700, which sounds crazy. But maybe they're paying $700 and they're saying you can raise the rents up to $700, and all of a sudden what you're finding out, this goes so much. Or maybe they're saying they're paying $700, but they're really paying $500.
Right.
So that's one big one, is the rent roll. You want to look at all their expenses, and you'll want to understand what is rule of thumb. In short, you see it ROT written everywhere in the commercial. What's the ROT? What's a rule of thumb? So typically that means maybe you're supposed to spend for maintenance $300 to $300 to $600 per unit, per door, per year, per unit, per year. And so if they are saying that they're spending $100, well, you should have a red flag that says they're probably leaving deferred maintenance there. Because if they're not at least at that 300 level, then they're probably not doing enough.
Yeah.
And they're showing that the NOI is high. And yeah, the net operating income does show higher when you're spending less in rehab.
Right.
But if you see that they went 500 a year, and then the next year was 500 a year, and then the last 2 years was 100 per door per year, then you'll understand immediately I'm going to be walking into a ticking time bomb, that all of a sudden you have millions of dollars of work that needs to happen in year one because they haven't kept up on it. So those little things, to really get into this, you should be probably spending a lot longer with learning this stuff than one podcast, but this is just to give you an idea that there are some crazy things that can happen. And maybe I'll share one other thing just in general.
Yeah,
there
please
is something
do.
called the expense ratio. Okay. And a lot of brokers that are sending out deals to new investors, that don't have the experience yet, they might show that net operating income is $800,000 per year, and its gross income is $1 million a year, and the expenses, and they'll list out some expenses, are $200,000 a year. Well, if I saw that, I'd be like, whoa, big red flag, because I'm usually looking for much closer to about a 50% expense ratio. And in general, that doesn't matter if you're in A class, B class, C class. Really, it's B plus to C minus. It's really about 50% is what you should be spending, because on the A's, you're marketing more. You're spending more in taxes. You're on the corner street, so your property costs more. You just have all these things that come up.
Sure.
On the B class, you have this. On the C class, you have more turnover. So if you don't have somewhere between 45 and 55% expenses that you're showing, I already have an idea that you're probably not showing me the right thing. So you're probably missing things. But if there was a new investor that came in and they're like, yeah, they make $1 million and they only have to spend $200,000 a year, and they're like maybe gullible in that way, that says that based on an 8 cap for $800,000 a year NOI, based on let's call it a 10 cap, this is worth $8 million. So really, you're probably looking at it being worth more like $5 million instead of $8 million, because of real expenses, and you could be overpaying by $3 million, just as an example.
Yeah, that could be really, really huge here. So are you seeing, like, if you're not working with sophisticated brokers, they could be sending you pro forma numbers, and that could be really sidetracking individuals that are brand new to it. And for folks that don't know pro forma is, it's basically, I guess, they're not real numbers. They're just going off of potentially what market rates, or potentially even less, to try and make the cap rates look inflated. What would you say to folks that are getting those types of things? Is you need to look at the hard numbers, right?
Yeah, absolutely. And I don't know if it's just new brokers that show you bad numbers. I think an experienced broker also could show numbers that don't make sense if they think that they have a buyer who will buy it. If they're selling you on a bad opportunity with faulty pro formas, I think that's potential as well, especially if you're new and you're not using correct terminology. Like if you're saying something like, what are the comps in the area for for those properties to sell? Well, they would be like, well, this person's not asking me the regular language that I'm used to hearing, which is, hey, what are properties trading for? The comps are for single family. So if you're using those same terminologies, there's a great option for that person to say, either you don't know what you're talking about, you don't have any experience, because you don't use the same lingo that we use.
Right.
And so they already catch you as a sitting duck. So my best advice, get educated and partner with people that have been doing it, so that you don't get taken advantage of.
That makes sense, Adam. And that brings me to the next part. And we'll touch on it, real quick. Well, not real quick, but with the time that we have allowed. That brings me to the question of syndication. So from a syndication standpoint, if you find good deals, but you maybe don't have the capital for those deals, because you said, it was almost a couple hundred deals or a couple hundred doors before you actually were, starting to use maybe a little bit of your own capital for transactions. So for folks that don't understand what a syndication is, can you kind of explain that for them?
Yeah, definitely. So there's really two main sides of a syndication. The definition of syndication is that a bunch of people get together and do something that none of them could have done on their own.
Sure.
So right now I have a 400 unit property that's under contract that it'll probably be closed before this episode airs, but there's this 400 unit. It's $23.9 million. I don't have 23.9. Okay, so in the syndication, what I'll do is I will say, our job is to manage the property, Your job is to raise the money. This other person's job is to analyze it. This other person's job is to do this. So I make a general partnership of different people to take on different roles of managing the asset. And then we make a limited partnership where the limited partners are only exposed as much as they invest in that deal. Okay. So there's a minimum of 50,000. So that limited partner will literally, the worst that could happen to them is that 50,000. They're limited to that. I'm on the hook for a lot of other things. I'm signing on the loan. I'm doing the due diligence. I'm partnering with the people. I'm on the hook for a lot more.
Sure.
But it allows one group of people to manage the property and one group of people to make money passively. And so that's pretty much what a syndication is. And on this property that should be closing here pretty soon or before this comes out, that's what we're doing is we have somebody raising the equity, somebody managing the property, somebody doing the asset management, and all these different parts. And because we only have collectively maybe like 800,000 in the general partnership. We'll use 450 of it to go down on that property, but then we'll raise another 5 million from other people.
Yep.
At maybe like 50K each. So we'll put down maybe almost 10% of the capital needed, and we'll raise like 92% of the capital needed from a lot of passive investors, and then we close on that asset. The passives or the LPs, limited partners, basically do nothing but collect checks, and the general partners are not really passive. So
Gotcha.
That's something to note is when you are a syndicator and you're the sponsor, which signs on the loan like we do, you have to come out with a little bit of your own money when you buy most of these, or your partners have to put out the money. So anyway, that's a little bit how it works, some of the ins and outs. And I do recommend the business model to other people so long as they get educated about it first.
No, that's awesome, man. We'll talk here in just a second about how people can reach out to you, because I know you got some exciting stuff coming up. And I appreciate you sharing that about the syndication. For folks that don't understand what that means, Adam just shared some really good information right there. And if you need more information on it, we'll be able to help you out here in just a second. So, Adam, I always ask this to folks that come on our show, and I really like doing it for myself personally, and it helps folks out too that are listening. But do you have any books that you've been reading lately that, entrepreneur books, self-improvement books, business books? Do you have any books that you would recommend or encourage to our listeners to read?
There is a book. It's called Compound Effect.
Oh yeah, that's a good book.
I did that the Audible way, and I learned there was a lot of really interesting takeaways that I think can be valuable to somebody, whether they're doing wholesaling, fix and flipping, multifamily, or even if they just want to have a better relationship with their partner.
Yeah.
Because it talks about doing subtle things. Like I recently made a promise to myself, compounding, that I'm just going to do one burpee a day and have one salad a day. Nice. It doesn't matter what else I do, but if I do one burpee, one salad, over time, I will be healthier, more fit. I'll look better. I'll have more energy. I will have accomplished something and felt good about it.
Sure.
And it's not so hard. It's not like I'm going on a crazy diet. It's not like I'm promising that I'll be in the gym, 4 hours a day, 5 days a week. But it's this one little thing that teaches you over time. You'll start to look more fit, feel better, and it's compounding, which they'll get more if they read that book, but they really should read it.
Nice, man. No, it sounds that is a good book to read. I highly encourage it. So 2 questions. How can people reach out to you, and any parting words from you, Adam? I know you've got an event coming up here. I wish I could attend, but it's something I won't be able to come to. So hopefully you'll have another one here soon, because I would love to be there. So how can people reach out to you, and parting words from you?
They just want to find me or my podcast. It's just real, like real estate. blue, the color, and spruce, the tree, realbluespruce.com. And that's us, the podcast, and they can find my email and everything like that.
This has been a really, really great show. And I highly encourage folks to check out Adam and his event that's coming up. Check him out with his podcast as well. If you need anything whatsoever from us, you can feel free to reach out to support@jasonluchesi.com. Again, that's support@jasonluchesi.com. I'd like to thank Adam one more time. Thank you so much for being on our show. Lots of great information shared about multifamily, commercial, syndication stuff. Really appreciate you, brother. It's been a really, really great show. So for those of you, yeah, no problem, man. Thanks for joining us today on the No Flipping Excuses show. Go out there, flip a house. We'll talk to you on the next episode. Take care. Bye.